Hey guys, it is Julie here with JT Wealth, and today we're taking a look at top tech stocks for 2023. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Today we're looking at a few stocks that analysts have dubbed as their top stock picks for the year ahead. Now, it has been a rough year in the stock market, with the S&P 500 being down 17% this past year. But the tech-heavy NASDAQ has struggled even more, down 30% over the past year. And the year ahead doesn't look like it's going to be a breeze. Inflationary concerns do continue to grow. While the Federal Reserve did only raise rates by 0.5% this time, they are still discussing future rate increases over the year, leaving investors a little bit concerned. Of course, there are a lot of talks about a recessionary period in the coming year. So we're looking to the analysts to see which of the tech stocks are their top picks that, though they might face some headwinds, could ultimately come out ahead at the end of the year. Just before we get into these stock picks, don't forget that if you enjoyed today's video to hit that thumbs up button and make sure you're subscribed to the channel as well. Keep in mind these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Now for our first analyst top pick, we have Microsoft. They trade under the ticker MSFT, currently priced around $250 per share. Now their stock has fallen 22% this past year, but is up ever so slightly the last 6 months, just over 2%. But at $250, they're still a long way from their 52-week high of $341. Microsoft is a behemoth of a company, so they've had a lot of different endeavors in the news recently. One of those being the fact that the company will be taking a 4% stake in the London Stock Exchange. This is a part of a long-term deal between the two companies where the London Stock Exchange has committed to spend $2.8 billion over the next decade, primarily in their Azure cloud service. They're also expanding their presence in the EV battery world with an investment in Group 14 Technologies. The tech giant is one of the investors in Group 14's recent $214 million additional financing round. Group 14 manufactures silicon battery technology and aims to reduce battery costs and boost the charging times of EVs. And probably most notable is Microsoft's $68 billion acquisition of Activision Blizzard. They are currently fighting for the deal up against antitrust regulators. The deal with Activision Blizzard would boost Microsoft's gaming presence, bringing over their popular games like Call of Duty. Of course, other gaming companies, such as Sony, are very much opposed to the transaction. Microsoft still has to battle this out with the FTC and make their case for the acquisition, so we'll see how that all plays out. Nevertheless, Microsoft is considered a great defensive blue-chip stock in the technology sector with high margins and free cash flow. In their most recent quarterly report, their revenue came in over $50 billion, which had increased 11% year over year, and operating income increased 6% to $21.5 billion. And with all this, Microsoft has been crowned a top-of-the-crop stock for 2023 by Credit Suisse. That top-of-the-crop designation entails the firm's highest conviction ideas going into next year. Credit Suisse analysts believe that Microsoft can continue taking market share in the cloud infrastructure market and will continue growing high-margin Office 365 subscriptions. And it seems that other Wall Street analysts agree with the potential. Currently on TipRanks, there are 28 analyst ratings, having the stock come in as a strong buy based on 25 buys and 3 holds. The average price target comes in at $291, which would be an upside of over 16% for current prices. On the low end, we do have one hold rating with a downside of 6%, but our most recent rating comes from Credit Suisse with a price target of $365, which would be an upside of 46% for this next year. Our second analyst top stock pick is one that is considered to be fairly recession resistant, which unfortunately could be an important quality for this coming year. That would be MasterCard. Their stock trades under the ticker MA, currently priced at $343. Their stock is currently up 3.8% over the past year, which demonstrates some of their resilience. They've managed to see 10% growth over the 6 months, but are still shy of their 52-week high of nearly $400 per share. Impressively, MasterCard has doubled its net income and revenue since 2017. And the business looks set to continue growing on the continued transition to cashless payments globally. MasterCard is generating high levels of cash, has low debt levels, pays a generous dividend, and is aggressively buying back stock. What helps make MasterCard so recession resilient is how the company makes their money. MasterCard is at the center of all transactions, acting as a toll operator responsible for the authorization, clearance, and settlement of payments. Not all consumer spending stops during a recession, as people do still need basic goods and services, and they are more likely to use credit cards than cash during this time. And it was recently reported that credit card balances marked the biggest increase over the past 2 decades, with credit card balances in the US increasing 15% year over year in the third quarter of 2022. And MasterCard shared their third quarter earnings at the end of October, where they saw third quarter net revenue of $5.8 billion, which was an increase of 15%, and their gross dollar volume up 11% year over year. They noted that consumer spending remains resilient and cross-border travel continues to recover. Analysts from both Bank of America and RBC Capital Markets highlighted MasterCard as one of their top picks for the year. They each highlighted how MasterCard is battle-tested for bad times. They also noted that nowadays MasterCard is more diversified. Service revenues offer a counterbalance to more cyclical consumer payments, accounting for 35% of total revenues and have compounded 20% over the past few years. Altogether, the MasterCard stock has 20 analyst ratings, coming in as a strong buy based on 19 buy ratings and just 1 hold. The average price target comes in at $396 per share, which would be an upside of 15% for this next 12 months. And the most recent rating came in today with an upside of nearly 18%. Over the last few weeks, we can see price targets ranging between 7 to 20% upside. And third on our list today is a company that is trading at prices that haven't been seen since 2019. That is none other than Amazon. Trading under the ticker AMZN, the stock is down 47% this past year, trading at about $87 per share. And the company has not yet seen a big bounce back, currently down 15% over the last 6 months. So Amazon stocks look pretty darn cheap right now, especially when you consider their cloud business, Amazon Web Services. It is a market leader and is growing at a rapid pace. And it is said that Amazon's cloud computing business is worth more than Amazon's total market value right now. Amazon Web Services has an estimated enterprise value by itself of $1.2 to $2 trillion, according to some analysts. And with a current enterprise value of about $1 trillion, you'd currently be getting all the other Amazon businesses, such as their retail, for free. Amazon is also holding their own in the streaming business. And according to a new estimate, Amazon Prime Video has more paid subscribers than Netflix in the US. They're saying that the success of this points to the strength of Amazon's Prime bundle and subscriber retention. Amazon also reported their third quarter endings on October 27th. While their net income did decrease to $2.9 billion in the quarter, net sales increased 15% to over $127 billion. All of this considered, Amazon has been named a top stock pick for 2023. With Wall Street believing that strong fundamentals, increased profitability, and a deeply discounted valuation gives Amazon stock about a 50% upside. One analyst notes that Amazon is benefiting from the continued secular shift towards e-commerce and cloud growth. And while Amazon likely faces a few challenging quarters ahead of a disappointing holiday shopping season forecast, they continue to have a strong portfolio of assets. And there is no shortage of analyst ratings on the Amazon stock to show you that they're feeling pretty bullish. With 36 analyst ratings, it does come in as a strong buy based on 33 buy ratings and just 3 holds. With an average price target of $140, that would be an upside potential of 60%, with plenty of ratings coming within the last few weeks, ranging from an upside of 35% all the way up to over 81%. So there we have 3 big names in the tech sector that analysts are feeling bullish on for 2023. Like we said, there could continue to be some recession-like headwinds going into this year. So it's a great opportunity to look for some bigger companies that can withstand this. And you guys know I always love hearing from you, so let me know your top stock picks for 2023, which companies you're feeling especially bullish on. Of course, make sure you're doing your own research and due diligence and that any investment decision fits your own risk tolerance and time frame as well. These videos are never a suggestion to buy or sell any specific stock. If you made it to the end of today's video, don't forget to hit that thumbs up button and make sure you're subscribed to the channel as well. Thank you guys so much for watching. Have a fantastic day, and I'll see you back here next time.